Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Folks listening, I'm Jason Balara with Lark Capital Group. This is Rachel McFarlane. She's our investor relations manager. And I just wanted to make sure that Rachel was here and was introduced to everyone, because as we're following up and talking and answering questions that may come up, Rachel is definitely a great source to go to. We also have Song, my assistant. She's not on tonight. She had a prior commitment with her kids, and she's on East Coast time. So we will forge on ahead. Maybe she would have known how to make this work faster, but unfortunately, we'll have to push through. So I'm going to go ahead and share my screen. And so what we're going to go through here today is just basically an overview and an update of our fund as it currently stands, and some pretty exciting announcements kind of towards the end. So the Lark Veterinary Impact Fund, we actually started it about a year ago. Some of the properties we have under management currently, and I'm not going to spend a lot of time on all of this. We did a webinar when the fund launched initially, so I'll probably breeze through a lot of the stuff at the beginning and get to sort of the update and exciting announcements that we have here. So a little bit about Lark Capital. We have acquired 337 units of multifamily that we are actively managing. We also have 450 plus units of self-storage, as well as 432 units of multifamily within the fund currently as it stands. We have over $80 million of assets under management, and we have strategically partnered with some mentors of mine actually that have collectively over 4,500 plus units, and I believe that assets under management is now over 850 million. So quite accomplished, and so we're trying to hitch our wagon to the right people. We started a fund for a couple of reasons. One was diversification. We'll talk about the structure of the fund. We also wanted to be able to take advantage of the opportunities that are coming available over this last year and then in the next coming, and we wanted to have an impact, and we're doing that through Not One More Vet. Again, we'll touch on a lot of that again as we move through it. Our fund is unique in a lot of ways, mostly in structure. There's not a lot of funds out there that are doing both multifamily and business acquisition. I don't actually know of any. There may be, but I think we have a pretty unique business model here. So why do we like these things? Of course, the strong fundamentals of supply and demand. There are still about 3 million plus housing units undersupplied for the population in the U.S. There is a lot of new supply coming online between now and 2025, but there aren't a lot of starts behind that. So essentially what we expect is to have fairly flat rent growth as we absorb these new units over the next 6 to 12 months. But then we're going to have growth again on the rental side as we don't have a lot of new supply coming behind that. The reason we're coupling these multifamily assets with businesses is specifically to impart the cash flow to the fund performance on top of the real estate the real estate tax benefits as well as appreciation. So our philosophy is always investor first. And I'll talk a little bit about where I'm implementing that within the fund, but investors first always. We're very big on family, and we do consider anyone who takes the risk of investing with us, and investing is certainly a risk, but we consider them part of our family, and we'll treat you as such. So we truly appreciate anyone who invests alongside of us within our deals. This is some of the team. Myself, Reed Nakamura, he and I co-founded this. Song, as I mentioned, is my assistant. She's now been working with me for over 2 years. And Rachel joined us this year as our investor relations manager. I've got a typo there. Investor relations manager. Sorry about that. We'll fix that, Rachel. So fund overview, the total equity to be raised within the fund is $10 million, and the anticipated life of that fund is 5 to 7 years. We're targeting B-class multifamily assets as well as established cash flowing small businesses. The way that the equity gets allocated within the fund, this is actually specifically defined by the SEC, and so we can do up to, the easiest way to explain it is up to 20% of the equity can go towards businesses. So we can't have the fund, if we're going to combine, we can't have it be entirely small businesses. So that's something that we have, sort of as a benchmark imparted by the SEC. The idea is to maximize opportunity and strategically improve cash flow and create an investing opportunity for accredited investors. If you are not an accredited investor and you get this webinar and you're interested in discussing investing, please still reach out, because we have other options that we can sort of get you involved with, or I can introduce you to someone who is doing a what they call a 506B raise, which would allow entry of non-accredited investors. Our minimum investment is $50,000, and we're doing monthly distributions. A little bit of a breakdown here on the investment classes. Basically, the way that we structured this, there is a preferred return of 10%. So before we see any of the profits, our investors will get at least 10%. And then we have a 70-30 split up to 14% IRR. And then anything above that, it sort of gets reallocated by the amount invested. So it's complicated. If you have questions about that, please feel free to reach out directly to me. And the first $2 million invested within our fund will all be treated as Class C. So they'll get the sort of highest equity split, most favorable equity split. This is just a sample multifamily pro forma. This is actually from Arcadia Cove, which is the asset that we have currently within the fund. I'm not going to go through all of this. I can send slide to anyone who's interested in looking, but I think you're probably more interested in how it's performed over the last year. This is another pro forma from a small business. Again, we're going to update here with some news that isn't just pro forma news, so we'll skip through this quickly as well. This was our sort of initial projections, and I created this slide to really illustrate the concept behind this fund. And so if you look at the top part, basically this is all kind of real estate related up here. And so essentially, if we're looking at it, we just used $500,000 as the overall investment, and you're looking at, sort of the returns on that money. This top part basically breaks down exactly what you can expect sort of on a year-to-year basis, based on pro forma from the performance of the multifamily assets that we are looking at. We then took small business cash flows from that sample deal that I showed you and looked at what, sort of conservatively we could layer on top of that from a cash flow perspective, and then just essentially added them together. When I modeled this out, what I did was, you can look down at the very bottom and you can see the total equity multiple is 2.5%, with an average annual return over 30%. So the idea is I took these pro forma multifamily assets and I added in the small business cash flow as it stands. So I didn't model in any growth in the business, which of course we're going to try to grow the businesses. I also didn't model in any sale of the business. So this is a very possible scenario where investors within this fund get all of their money back and then some, and we still own the businesses, in which case they'd be receiving essentially infinite return on investment for their equity in those in those businesses for as long as they're continuing. So some of the benefits of investing in this fund, we've gone through it. I don't want to read through the whole slide again. I think these are things that people can read on their own and reach out to me with specific questions. Our investment strategy, I've talked a little bit about it. We have, we're looking at very, very safe, conservative assets on the multifamily side. There's a reason why we haven't found another one that worked since a year ago. In fact, there have been other opportunities we've run into that I have declined, and really because I want the whole goal here is to make this as safe as we possibly can. So in our multifamily markets, we're looking for strong locations, population growth, and employment growth, and we're looking at high barriers to entry and high earning industry segments. So we don't want just employment growth, we want employment growth within residents that are making a high salary. So essentially what that boils down to is we want renters by choice in our assets. That's really instead of by necessity. And so with that, we're really looking at 100 plus units. We still want a value add strategy. If we can implement our construction skills, that's very useful in terms of increasing value of these assets. We're looking for assets that have an outsized return profile. So we want sort of better than average returns. We're looking at Class A and B multifamily and currently underperforming assets that we can turn around. So some of these things we've talked about. We have strategic partnerships. We have a track record in both real estate and business. We are very, very impact driven. We pride ourselves on being transparent. I'm happy to answer any questions on any deals, whether it's the fund or past deals. And we have built a team that has sort of alignment of focus towards what we consider a very important impact that we're going to have with our fund. So why are we doing this now? I think there's been a lot of talk about the economy over the last, coming up on 2 years now. That will probably continue in the next, 2 to 3 years anyway. Multifamily has historically outperformed other asset classes. Over time, it's a very, very safe, I would say, a safe asset class to invest in with high returns based on the risk profile. It's no secret that some of these other, specifically office, has been pretty damaged over the last few years. So, but people will always need a place to live. The stock market, I like the stock market, I invest in the stock market, but I think it's really important to understand that it is maybe not as diversified as you think. So if you just go out and invest in a mutual fund that sort of covers the entire S&P 500, we have seen a lot of volatility in the stock market over the last couple months. And the reality is over the last year plus, where we have had actually pretty good returns in the S&P 500 overall, almost all of that has come entirely from the Magnificent Seven that they talk about, all the tech stocks. So when they do well, we do well. When they don't do well, we don't do well. And you can see the shifts in the stock market have been very much reliant on stocks like Nvidia and Tesla and Facebook and Apple and Amazon and all stocks I love and have some shares in, but important to understand that that's probably not quite the cross section of the entire S&P 500 that you think it is. So multifamily has traditionally provided resilience in recession. Doesn't mean it doesn't get hit when we have down markets. It just means it tends to not be hit quite as hard. So like I said, we're looking at some specific things on the multifamily side that really impact what we're looking for in those assets. So necessity renters, those are going to be the people in Class B class. We have in A class almost entirely lifestyle renters who are renting by choice. So B class is going to be that mix. And I actually think a lot more people are shifting towards rental by choice, even in the B class. We're looking at things that are coming at a discount right now. Brokers are reaching out with people that are, or with sellers that are starting to recognize that prices might be down. We're looking for higher yields. We're looking for ways that we can impact the NOI and really turn an asset around. and we are looking for affordability. So that's another reason for B class assets. Small businesses. I mentioned earlier why we went with these. Essentially, we're looking for established businesses with in-place operators. I think that's very important. We want low overhead. We are at a point in demographics where the baby boomer generation are heading into retirement, and they are the largest business owning demographic of all age groups, and many of them are ready to sell their businesses. So there's a great deal of opportunity there. So again, I went through that quickly. If you have specific questions, I'm more than happy to jump on a call or you can email me. But I really want to focus on kind of the updates and the performance of the fund thus far, and also kind of some exciting announcements. So this is that same slide that we looked at before with our projections, and I basically put it out there as far as what we have actually achieved in the first year. So we projected a 4.12 average annual return, cash on cash return, in the first year. We actually, from a distribution standpoint, we achieved 3.9%, which is slightly underneath. However, when we pooled our capital, we actually got a 3% discount on our pooled capital. So you can actually add 15,000 to that overall return, and it increases the overall return to investors by doing that. We have had a sort of frustratingly slow acquisition pipeline on the business side. Been looking for just the right opportunities. To be honest, I probably looked a little too small at first, and realized that the smaller businesses aren't going to provide quite the level of cash flow that we want for our investors. So I've shifted that focus some, and I expect that to really help here over the next couple of years. So here's the big exciting announcement. We are under contract on our first small business acquisition. It is a construction business, and the bulk of the work within this business is focused on apartment complex CapEx projects, which is effectively exactly what we do with our apartment complexes that we already own. This business is located in California, but is currently being operated with absentee ownership. So the seller actually lives in Nevada. So he's been operating this business for a number of years from a distance. He's retiring and offering seller financing. The in-place cash flow is already very, very good, and the cash on cash calculations are over 100% in the first year. So I'm going to get into those numbers a little bit more, but this is why we think that layering businesses on top of real estate is such a good idea. Also, there's a huge opportunity for growth. The seller is heading into retirement and has basically declined any opportunities that he's encountered for growth over the last number of years. Some specific ones that I've noted that we can add to our portfolio here is the ADU market, accessory dwelling units. So like people that are building additional units in the back of their homes. People are adding ADUs onto apartment complexes where there is space in California. So there's a huge demand for housing here, huge demand for affordable housing. And so the ADU market has gone crazy because I think it was 2 years ago, California actually changed the rules and is allowing people to add ADUs to their properties. So you can take whatever you have. You can take a single family and turn it into maybe 2 or 3 units, but you can also take, a 6-unit apartment complex, a 10-unit apartment complex, and add in multiple additional units if they have garage space or anything like that. So that's a huge opportunity in business that is booming. The other one that is very, very new, it's Ordinance SB 326. It's also known as the California Balcony Inspection Law. So anything with an HOA, and this just passed, anything with an HOA has to have all of their above ground exterior structures inspected. And so basically that's why it's called the California Balcony laws is anything that's a deck or a balcony has to be inspected. There's going to be lots of those that don't pass inspection. They're going to have to be repaired. So there is an opportunity to take advantage of that market specifically and be very active in helping, kind of bring all of those HOA structured buildings up to code. All right, so that's kind of it for what I wanted to announce. I'm going to show you another couple things here too, but basically, the best thing we can do here is schedule a call, and I can go into more detail. You can talk to me, you can talk to Rachel. Everything is also on the website, and we will send out recording of the webinar as well as the deck to go along with it. But I truly, truly believe that this is where we see tremendous growth in terms of returns within this fund, and I'll go into those numbers a little bit here. There's just our disclaimer, kind of talking about this is basically all of the legalese that has to go along with anything. So you'll receive the deck. You can look through this. Of course, anybody who decides to invest gets a PPM, which is a private placement memorandum, talking about all of the legal implications of investing and everything like that. But much easier to talk through it than to try and read this to you here. So I want to stop sharing this. I'm going to bring up something else that is pretty exciting to me as part of this announcement. So I've talked a lot about my background in construction, and I think that's probably an easy thing for me to say. A lot of people know me as a veterinarian, and I certainly am. I'm still a veterinary surgeon. A lot of people know me in a lot of other capacities, but I have been in construction for before I was a veterinarian. I was a teenager when I started in construction. I've worked in almost every capacity in the construction field. Never bothered to get my license. I ended up becoming a veterinarian, got a different type of license, but something that came up in this business acquisition and at first why I avoided construction businesses despite my background is I didn't know if I could obtain a license here in California. Well, as it turns out, I'm well qualified for it. I've already created the entity, Lark Construction Services, and I am applying for my contractor's license. So that will open up a ton of doors in the construction field for us, and allow us to sort of expand our business acquisitions within that specific vertical and tie it in very, very well to all of our real estate dealings. So pretty excited about that. It takes 4 to 6 weeks for the application to go through, and then another couple weeks after that to be able to take the exam, but not worried about any of that pushing through. The next thing I'll share with you here is a little bit of the numbers around this business. So, can you see that, Rachel? Is that up on the screen?
It's a little small in
Okay.
Zoom. Yeah.
Yep, I'll zoom in. So ultimately, what I want to show people is the most important thing, especially from an investor standpoint, is going to be what those returns are. And so when you look at this, it doesn't actually allow me to scroll without doing this. When we look at these returns here, so this is a seller finance deal. They are asking for a down payment of $250,000, and on a $750,000 purchase price. What that provides for us after debt is a monthly cash flow. I'll zoom in here, of over $20,000. So that's after the debt service is paid, which comes out to an annual cash flow of $269,139 based on, that is current in place cash, which is a cash on cash of over 100%. So when I talk about that stuff, and the cash flow behind theirs, that's a very real thing. But I want to clarify that we want to grow these businesses, and so the idea is not to immediately distribute all of that additional cash. But if you look at it from a numbers standpoint, if you use $1 million as the overall amount raised, our preferred return is 10%, so that's $100,000 a year, which is less than $8,000. Sorry, less than it's about $8,000 per month, a little more than $8,000 per month that we would need to distribute to meet our preferred return at 10%. So that is a very, very doable number, and then we can invest in some growth in the company, and we can also have continued distributions along the way. So the numbers make a tremendous amount of sense. Again, I don't want to get into all of that on this webinar, but I think that those are important things for people to understand. A couple of questions that have come up in talking to investors here throughout the last few months. I want to bring up two in particular. One, and I think this is a really important thing for anyone who has been investing in real estate over the last few years. I had an investor ask me who has invested in our fund, and he has also invested in our one or two of our past deals. And he asked me, well, why am I getting distributions on the fund and not the past deals? And the reality is real estate went through a hard period leading, basically between mid 2022 until now. It continues to be hard on the pre-existing deals. We had an extremely hot market. Things were bought with what's referred to as bridge debt, so short-term debt with oftentimes floating rates. And so what a lot of operators have had to do is to shift to capital preservation and not being able to send out distributions. It doesn't mean that those people won't get their money back or make a return. It's just going to take longer, and there needs to be preserved capital along the way. So I can understand, because of that, there's some fear out there. Now, his question was, well, why am I getting a distribution on the fund and not otherwise? And so the reason is timing. The fund came into existence in 2023 after we had already figured out and been through what the market was doing, and we're in the midst of that reset. So our current asset, Arcadia Cove, is on fixed rate debt, and it has an additional 6 years until that debt matures. And so we got a fixed rate debt of under 3% because we were able to do a loan assumption. So any of the deals, this is why I say we're going to be extremely safe and conservative. Any of the deals that we would look at on a multifamily side are either going to be something like that, an assumable loan that's at a low rate with a lot of runway still, or it's just going to have to be priced at such a way that we can get the debt at the current interest rates and have it still allow cash flow. And so right now, that's why it's been hard to find deals. But that's the reason why currently our fund is distributing, and it's distributing, like I said, about 4.5%, which isn't amazing. The follow-up question to that would be, why wouldn't I just put my money in a high yield savings account, right? I can get 4.5% in a high yield savings account. Well, there's two reasons for that. One is there's no upside in that high yield savings account, right? So it's just going to be that forever. It's not going to go up as the rents increase on this asset. It's not going to give you a big chunk of money when this asset sells in a few years. So there is no upside. It stays at that. Granted, it's safe, although most of those high yield savings accounts, you may not know it, but those rates are floating. And so when the rates start to come back down, the rates on those savings accounts will also come back down. So just important to understand, there's nothing wrong with a high yield savings account, but important to understand the difference. The other reason is we have a 10% preferred return. So although we're distributing what we have right now, when we catch up, that's going to bring everybody back up to 10% and beyond. So it's the high yield savings account's not going to do that either. So it's something that the calculation of your 10% preferred return starts when you invest. So our investors that have been getting, 4.5% of actual cash, they're still owed 6.5 or 5.5% of additional preferred return that will come in as we bring these businesses in additional assets. That's how a fund works. The other question that I got recently that I think maybe I'm just not doing a good job of explaining the fund structure, but I had someone ask me who is invested in the fund about being a part of this new deal, meaning the acquisition of this business. And he said, "Oh, it sounds like that's even better than what I'm already in." And I had to explain to him, "You are in this deal already." So the if anybody has any question that is a existing investor in our fund, you are already a part of this business acquisition. The way a fund works is you are going to receive a portion of the profits for any of the assets that get bought within the fund. Now, the same thing applies to people who enter the fund now. They're buying in, they'll be a part of this business acquisition. They'll also be a part of the multifamily asset. So it's something just to remember that the structure of a fund versus a single deal is a little bit different, but in a lot of ways it's better in terms of diversification for sure. I know we had a lot of technical difficulties. Oh, good. We have questions here. All right, so we have a question. What happens to the real estate or businesses after 5 to 7 anticipated years of the fund? In particular, are the businesses sold? So it's a great question. The real estate will almost certainly be sold within that time frame because of the debt structure. And that's generally how it works for these large-scale commercial assets. They have typically anywhere between a 5 and 10 year hold time. So the real estate assets will get sold. The businesses, I mentioned this earlier, and I'll try to explain it sort of in a different way, right? So in the financial model that I presented before, in all of the modeling I've done for this fund, all I took was the existing business cash flow, the in-place cash flow. I did not model any growth. I did not model any sale. So the returns that you see are based on that alone when it refers to the businesses. So one of two things can happen there. One, we can have growth in the business and reach a point where it makes a lot of sense to sell it because we've increased the value so much that it is worth, sort of recapitalizing and bringing all that money back in. The other thing that could happen is, we've sold the real estate, we've cash flowed so much, investors have made their, 2 to 3x on their money in the 5 to 7 years, but maybe those businesses are doing great and they're churning out capital, and we can just continue to be paying distributions without having any money still within that fund. So essentially at that point, you're receiving an infinite return because you have a piece of the businesses within the fund. Another question, how long is the fund's raise period open and where are we at the $10 million goal? The raise per the PPM ends at the end of this year. I don't honestly know if I can change that. That's what we put in the initial paperwork. I don't know if I can extend that if we don't reach the $10 million goal by then. We currently have raised, we have $500,000 in the first deal. And then we've had a number of people express interest since bringing on this business or getting this business under contract. So we definitely have a ways to go. I don't know. We may or may not fill it, but it doesn't mean that we won't have exactly the same tenacity in terms of achieving the returns for the investors we have, regardless of how much the total raise is. There's a couple things I mentioned being investor friendly. There's a couple things that I do because I believe this is the right thing to do. But one, Our initial investment in Arcadia Cove was a fund-of-fund structure, so I don't actively manage that asset. We partnered with a mentor of mine. They have a long track record and are excellent operators. And so we brought our investors into that deal. I don't take any fees. I don't take any asset management fee. I don't take any fund management fees. I take no fees on that. So there are expenses that go along with the fund, like the filing taxes and things like that. But I don't take any fees. I want to pass everything through to investors. I'm also an investor in the fund, so it behooves me to treat investors well, right? The other thing is on the businesses that we acquire, I'm not going to take a salary. I will take an asset management, a portion of the revenue generated, so that whatever I get out of it is performance related. So again, I think that allows me to always put investors first in that. And thanks to Danny, he just said that we can actually extend the fundraise term. So I think that I figured that would be fairly flexible. I just hadn't gotten around to checking in with the SEC attorney. Honestly, whether or not I do that, I think will just depend on where we're at in the raise and if it seems to make sense. But I think that the reality is that we have some great opportunities in front of us. This deal that's under contract, the numbers work very, very well. I've been in discussions with business brokers on a number of other businesses as well within the construction vertical, so that we could tie it all together and actually really create quite a high cash flowing business structure there. I don't see any more. Oh, here we go. Yeah, that's a great question, Danny. So will there be a division of management oversight and accountability on the team between real estate and small business? Yes, there will be. The businesses that I'm looking at actually are with in-place operators. So I can't go out and buy myself 4 or 5 jobs. That's not gonna benefit anybody. There also just isn't enough time in the day. So yeah, there will be a division of management. One of the nice things about the concept of bringing multiple construction businesses into the fold is that we can actually hire construction managers to oversee all of those operations. So the ability to grow the team because there's actually revenue coming in will be huge. We've already sort of started that process. Like I said, bringing Rachel on board, but also I've talked to a couple people that I'm looking at as potential COO type of positions. I don't see any other questions there. Rachel, any questions that you've gotten or have that you want to share? No. Okay. Perfect. Well, I'm sure there will be questions. Please definitely feel free to reach out to me. My number and email are in the pitch deck, but we have, I'll just put it here too. It's jason@larkcapital.com. And my phone number is 508-561-3269. Most of you probably already have access to that. But thanks for those of you that joined. I'm sorry about the technical difficulties. We will definitely get this edited and a recording sent out as soon as possible. Appreciate you all.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?